Good evening and welcome to another episode of Night Markets, where each week I'll be giving you my perspective on what's driving markets, as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. So, as investors appear to rejoice over Federal Reserve Chair Jerome Powell's announcement that interest rate reductions would be imminent, the Dow Jones Industrial Average as well as the S&P 500 resumed their upward trajectory towards record highs. The gains were mostly widespread, with small caps outperforming large caps, and the equal weighted variant of the S&P 500 index also outpacing its more familiar capitalization-weighted counterparts. Trading volumes were, however, noticeably low for the majority of the week, resulting in some of the lowest daily trading volumes of the summer. So before we move on to markets and macro, let's just check in on the current situation in the Middle East. So on Sunday morning, Hezbollah launched hundreds of missiles and drones at Israel, with Israel's military claiming that it struck Lebanon with approximately 100 jets to prevent a more significant attack. This was one of the most significant clashes in over a decade of border warfare in the region. On Monday morning, oil and gold initially jumped, but has pulled back since. And so after the most dangerous confrontation between Israel and Hezbollah in the 10 months since they renewed combat, the Middle East is back to where it was the day before. Still on edge over missteps, but embracing a kind of choreographed containment that, at least for now, avoids all-out war. So kicking off the segment on macro and markets, let's start in the US. In terms of its influence on sentiment, Powell's speech at the annual economic symposium of the Kansas City Fed in Jackson Hole, Wyoming, appeared to be the most significant event of the week. In particular, stocks experienced a surge at the commencement of trading after the text of his speech was released. In the speech, Chairman Powell acknowledged that the time had come for policy to adjust, suggesting that policymakers would reduce rates at their upcoming meeting in September. Additionally, the publication of the minutes from the Federal Reserve's most recent policy meeting earlier in the week also appeared to show improved sentiment. It seems as though a majority of participants believed that a September rate cut was likely appropriate, and several members had even considered the case for a July cut in light of the recent disinflation and the labour market's improved balance. Despite the good news on rates, the market did appear to retreat in response to some less dovish remarks from a few Federal Reserve officials on Thursday. In particular, Kansas City Fed President Jeffrey Schmidt indicated that the labour market remained relatively robust and that there was still much to be done regarding inflation. Other than that, the economic calendar during the week was largely consistent with expectations and did not really appear to significantly influence markets. The one notable release from a macro point of view was the Labour Department's annual revision of its non-farm payroll count through March. 818,000 fewer jobs were added over the previous 12 months than had originally been reported. This was the largest downward revision since 2009. And then moving across to the Eurozone and United Kingdom, according to S&P Global's Purchasing Managers Index, business activity growth in the Eurozone resumed in August after experiencing stagnation in July. As a result of the Olympic Games in France, the services sector output reached a 4-month high, resulting in the Eurozone Composite PMI Output Index increasing to 51.2 from 50.2 the previous month. Nevertheless, manufacturing production experienced a 17th consecutive month of decline. The ECB also reported that the growth in wages in the Eurozone, a critical data point for monetary policymakers, decreased from approximately 4.74% in the previous 3 months to 3.55% in the second quarter. So while this is good news from an inflation point of view, the data was less complimentary on the growth front. In its August report, the Bundesbank in Germany stated that the anticipated gradual recovery in the economy is being further delayed due to sluggish foreign demand. And in the UK, data from purchasing managers for August indicated that the economy's private sector output continued to expand steadily with the assistance of more robust orders. The preliminary estimate of the UK S&P Global Composite Purchasing Managers Index in August was 53.4, which is an increase from 52.8 we saw in July. This most recent PMI reading was also the highest we've seen since April. So despite the rather lackluster data we saw out of Germany, in local currency terms, the Pan-European Stocks Europe 600 index ended higher by 1.31%, amid growing hopes that the Fed as well as the European Central Bank would cut interest rates as early as next month. And then moving across to Asia Pacific, over the course of the week, Japan's stock markets experienced fairly modest gains, with the Nikkei 225 increasing by just under 1%, and the broader Topix index ending largely flat. The Bank of Japan governor reiterated that the central bank would continue to normalize its monetary policy as it gains confidence in the economy's ability to achieve its 2% inflation target in a stable manner. Despite some speculation that the recent market turmoil we saw at the beginning of August could actually discourage the Bank of Japan from further interest rate hikes. The yen strengthened on this news from approximately 147.6 at the end of the previous week to around 145 in response to the divergent monetary policy outlooks for Japan and the US. We also saw the yields on the Japanese government bonds increase from 0.88% to 0.9%. Interestingly, the Bank of Japan governor was summoned to testify at a parliamentary hearing on Friday regarding the central bank's plans for the normalization of its monetary policy to specifically respond to the market turmoil that we saw at the start of August. The governor reiterated that the Bank of Japan's position remains unchanged. It will modify monetary policy if economic and price developments align with its projection. However, he did observe that despite the fact that we saw the Japanese stock market recover its entire devaluation, that he believes markets remained unstable. The Bank of Japan would therefore continue to monitor the situation with a high level of urgency, and they would pay particular attention to any sharp yen moves that could affect its inflation forecast. Then moving on to China, a fairly light economic calendar, as well as caution in anticipation of Fed Chair Jerome Powell's Jackson Hole speech, caused a lack of interest from buyers, and Chinese equities subsequently declined during the week. The People's Bank of China also maintained its benchmark lending rates at the same level on Monday, with the one-year loan prime rate remaining at 3.35%, while the five-year loan prime rate, which serves as a policy rate for mortgages and other long-term loans, was also kept at 3.85%. After the People's Bank of China unexpectedly reduced several critical rates in July, economists largely anticipated that the bank would maintain its stance on both these rates. Nevertheless, a significant number of economists anticipate that China will experience additional easing this year as the Federal Reserve starts to reduce rates in the United States. And on the earnings front, Baidu, the leading search engine in China, disclosed that its second quarter revenue was lower than anticipated, despite the fact that its earnings exceeded analyst expectations. And then bringing it back home, on Wednesday, Statistics South Africa announced that the local inflation rate dropped to the lowest level in 3 years, supporting the case for monetary policy easing this quarter. Consumer prices rose by 4.6% in July from a year earlier, compared to the 5.1% increase we saw in June. This is also the lowest level since July 2021, and it was also below the 4.8% median forecast by economists. The largest contributors to the inflation slowdown in July were a decline in the goods inflation rate to 4.6% from 5.5%. And core inflation, which excludes the more volatile food and non-alcoholic beverages, fuel and energy, only rose by 4.3% compared with 4.5% in June. The stronger rand, partly buoyed by the new business-friendly coalition government, is also likely to reduce risks to the inflation outlook and possibly support the case for some further domestic monetary policy easing. The outlook for the rand could also possibly improve if the Federal Reserve starts to cut interest rates, and this may force the ZAR to actually consider reducing borrowing costs by 50 basis points at least once this year, as South Africa's real interest rate is currently at its highest level in 18 years. The Monetary Policy Committee will disclose its next decision on September 19. And just looking at what the markets are currently pricing in with regards to that meeting, forward rates agreements are pricing in about 70 basis points of the interest rate cuts by the year end. And the rand also subsequently weakened to around 17.92 to the US dollar post the release of the data. The local unit did, however, recover towards the end of the week to end at 17.75 to the US dollar. Bond yields and swaps across the curve also dropped during the week following the good inflation news. The All-Share Index ended the week higher by 1.84% in line with global markets, as we saw the industrial sector being the best performer, ending higher by 2.29%. And then just looking at the week ahead, the rally in US markets will be put to the test this week with earnings from the chip-making behemoth NVIDIA that's being released on the 28th of August. NVIDIA's earnings report, in conjunction with the company's anticipated continuation of corporate investments in AI, could serve as a critical inflection point for market sentiment as we approach what has historically been a volatile period for the year. The stock of NVIDIA has increased by approximately 150% year to date, which accounts for approximately 1/4 of the S&P 500's 70% year to date increase. The Eurozone and Australia are also scheduled to disclose inflation data that will inform the trajectory of interest rates for the year ahead. The highlight of the economic calendar for the week will be Friday's Personal Consumption Expenditure Price Index, which serves as the Federal Reserve's preferred inflation yardstick. On the local front, Wednesday's release of the latest Producer Price Index data could also further cement the case for an interest rate cut, as this measure tends to lead its consumer counterparts. And then, as always, we'd like to end off our segment with an interesting investment discussion we had during the week. This week, we had a chat about the continued dominance of large-cap tech stocks, which has accelerated in response to the excessive hype surrounding artificial intelligence. This has resulted in the inability to really keep pace unless one possesses positions of over 7% in NVIDIA, Microsoft, and Apple. We have become more cautious regarding tech stocks because of the dominance of a small number of very large cap companies driving all of the performance. Since the start of 2023, the equal weighted index of the S&P underperformed its market capitalization counterpart by a factor of 4. History actually shows that after the S&P 500 outperforms this much, it goes on to underperform by even more over the next 3 and 5 years, with no exception so far. On average, the next 3 years resulted in over 20 percentage points of underperformance by the S&P 500, and the next 5 years produced over 40% underperformance. So in conclusion, this indicates that on the balance of probability and if history repeats, the case for active management in the equity space could once again make its return. Thank you for joining me for another edition of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.